The final criteria for showing whether a trend is still in existence is the T line. This makes the indecisive trading days that you can't tell which way the market's going much more clear by using the simple rule that as long as they're closing a trading entity above the T line, the uptrend remains in progress. The same scenario is applied to the NASDAQ, with it staying up above the T line. So when you can add up that they didn't have enough strength to close below the T line, that we still have to assume that investor sentiment has the markets in an uptrend. Our recommendation on buying Roku today was based upon seeing a buy signal, such as the bullish engulfing signal, followed by a doji sandwich. Again, a doji sandwich is very easy to identify. You have a big bullish candle, a doji. And then the simple doji rule says the price is usually going to move in the direction of how they open after a doji. So if it opens positive, the doji sandwich usually indicates that this candle right here is going to be the same magnitude as this candle right here. Knowing that also tells you that the T line, which they've been trading below the T line, is now going to be breached and trading above the T line. So because we know the doji rule, and we also know the doji sandwich rule, which is when you see a doji sandwich, more than likely you're going to see a continued uptrend. This tells us this reversal has occurred. Now we can make adjustments or assessments as to where our next target is. That if it comes back up into this trend, it's going to come up pretty close to the $115 area. Now that becomes your first likely target, which the probabilities show that it's probably going to move in that direction based upon your stochastics now coming out of the oversold area, that you can make plans on what type of trade you want to do, whether you buy the stock outright or maybe you buy calls or call spreads that become much more feasible knowing where your likely target's going to be. The same recommendation was based upon our recommendation on QD, where you had kind of a bullish doji sandwich that bounced off the 50, that you can visually see you're in an uptrend, that positive trading today would be confirming the bullish doji sandwich, staying above the T line, also making the top of the trend channel a high probability target. This is not rocket science. This is just identifying the signals and the confirmation of those signals based upon what human nature normally does and the signals that they create normally in human nature. And when you add the strong signals, like we saw on Amazon, which is a bullish flutter kicker, again, opens here, closes here, then gaps up the next day and does a doji above the open, knowing the doji rule that if it's trading positive the next day, if you took out this little flutter, this basically becomes a kicker signal. And if you can see, that's pushing toward a resistance level, making a fry pan bottom, just gives you that much more probabilities that the bullish sentiment has come back into this chart, that you got a high probability that you're going to be trading in an upward direction. Candlestick analysis is just nothing more than analyzing what human nature does based upon the patterns and the signals that can be easily recognized from hundreds of years of analysis. Knowing what signals to look for at the appropriate levels, such as our best friend breakout, the strongest reversal signal, a doji followed by a gap up in price, the uptrend remains in progress as long as we stay above the T line. Knowing these simple trading factors of human nature allows an investor to have positions on in the portfolio where the probabilities are constantly in their favor based upon what the analysis of the signals and patterns have resulted in over hundreds of years of use by the Japanese rice traders. That'll be it. We'll see you in the chat rooms.